Right now, somewhere in a building you'll never visit, someone just created $2 trillion. Not printed it, not mined it, not earned it, typed it. No machines hummed, no presses ran, no gold moved an inch. A number changed in a database, and the entire world quietly rearranged itself around it. Here's the uncomfortable part. It wasn't the government that did this. It wasn't the Treasury. It wasn't even, technically, the Federal Reserve. It was a bank. Probably one you've walked past this week. Stick around, because by the end of this video, you'll never look at your bank balance the same way again. Most of us grew up with the same story. You deposit money in a bank. The bank keeps it safe in a vault. When you need it, it's there. Simple, comforting, almost entirely wrong. Here's the twist nobody tells you in school. Banks don't lend out the money you deposit. They create new money the moment they approve your loan. Not metaphorically, literally, out of nothing. That sentence sounds like a conspiracy theory. It isn't. It's in the official documentation of some of the most conservative institutions on Earth. The Bank of England said it plainly in a 2014 paper that quietly rewrote everything economics textbooks had claimed for decades. So, if banks aren't just moving money around, what exactly are they doing? And if that's true, who's actually in charge of how much money exists? Let's take this apart, piece by piece. To understand who creates money, you first need to understand that money isn't one thing. It's three. Layer 1. Central bank money. This is the reserve money that only a central bank can create. The Federal Reserve, the Bank of England, the European Central Bank. It exists mostly as digital reserves that commercial banks hold with the central bank. Ordinary people never touch it directly. Layer 2. Commercial bank money. This is the number you actually see on your banking app. It's a promise, an IOU from your bank to you. And here's the part that breaks people's brains. This is the layer where most new money is actually created. Layer 3. Physical cash. The paper and coins. The part everyone assumes is real money. It's actually the smallest slice of the pie. In most developed economies, cash makes up less than 10% of the total money supply. 10%. The thing you can hold in your hand is the least important form of money in the modern economy. Everything else is a number in a system, trusted by agreement, backed by nothing you could ever put in a safe. Let's follow one loan, from the moment it's approved. You walk into a bank. You ask for a mortgage, say $300,000. The old story says the bank checks its vault, finds $300,000 sitting there from other people's deposits, and hands it to you. Here's what actually happens. The bank doesn't move a single existing dollar. It creates two entries in its ledger simultaneously. One, an asset, your loan, which the bank now expects to be repaid with interest. Two, a liability, a brand new deposit, $300,000 sitting in your account. That deposit did not exist 30 seconds ago. It exists now because a bank employee, or increasingly an algorithm, decided you were creditworthy. You now have money to buy a house. The seller now has money to buy their next home. Their bank now shows a new deposit too. Round and round it goes. This is called credit creation, and it means something almost nobody fully absorbs the first time they hear it. The vast majority of money in the modern economy was created by a private company deciding to make a loan. Not government, not central banks. Banks. That should feel like a bigger deal than it does. If you took an economics class, you probably learned something called the money multiplier. The idea: a bank takes deposits, keeps a fraction in reserve, say 10%, and lends out the rest. That new loan becomes someone else's deposit, and the process repeats, multiplying the original deposit many times over. It's a tidy story. It's taught in nearly every introductory textbook. It's also, according to central banks themselves, backwards. The Bank of England's own research described this as one of the most persistent misconceptions in economics, because in reality, Banks don't wait for reserves before lending. They lend first and find the reserves afterward, if they even need to. Reserves aren't the fuel. They're closer to the receipt. So why does the old story survive? Maybe because banks create money out of nothing, then figure out the paperwork later is a much scarier sentence to put in a first-year textbook than banks carefully multiply your savings. One version is comforting. The other is true. Now, before this starts to sound like banks have unlimited magic, they don't. There's a leash. Several, actually. Leash 1. Capital requirements. Regulators force banks to hold a cushion of their own capital against the loans they make. The riskier the loan, the bigger the cushion has to be. Create too much money on too little capital, and regulators shut you down. Leash 2. The central bank's interest rate. This is the real lever of control. When a central bank raises interest rates, borrowing gets more expensive. Loan demand drops. Money creation slows. When it cuts rates, the opposite happens. The central bank doesn't create most of the money, but it sets the price of creating it. Leash 3. Confidence. This is the quiet one, the one that matters most in a crisis. Money created by banks is really just trust, encoded in a database. The instant enough people stop trusting a bank to make good on its promises, a bank run begins. And once that starts, the money that was created starts to look a lot like it was never quite real to begin with. Which brings us to the year this stopped being theoretical. In the years before 2008, banks created an extraordinary amount of money, mostly through mortgage lending, much of it to borrowers who had no real ability to repay. For a while, it worked. House prices climbed. The money created against those houses climbed with them. Then the trust cracked. Homeowners defaulted. The loans, the assets banks had created money against, turned out to be worth far less than promised. And because that created money was sitting in millions of other accounts, pension funds, and institutions worldwide, the crack didn't stay contained. It spread. Central banks stepped in and did something almost poetic if you think about it. They created new money, trillions of dollars of it, to replace the money that had evaporated when the trust in bank-created money collapsed. Money created the crisis. Money was used to contain it. It's the same tool, wielded by two different hands for two very different reasons. And most people watching the news in 2008 had no idea either hand existed. Here's why all of this actually matters to you, and not just to economists. If banks create money by deciding who gets a loan, then banks are, quietly, deciding where society's resources flow. Not the government, not voters, loan officers, algorithms, and risk models. Money isn't neutral. It's not just a measuring stick for value that already exists. It's created into existence, aimed at specific purposes: mortgages, business loans, credit cards, and withheld from others. Every recession, every housing boom, every credit crunch you've ever lived through was, underneath the headlines, a story about the taps of money creation opening or closing. And the wildest part? Most of us go our entire lives assuming money is a fixed, finite thing, like it's mined out of the ground in limited supply. It isn't. It's manufactured, daily, in the ordinary act of somebody, somewhere, signing off on a loan. So the next time someone tells you money doesn't grow on trees, remind them it doesn't need to. It grows in spreadsheets, boardrooms, and loan applications, created by decisions most of us never see, made by institutions most of us never question. The dollar in your pocket isn't the story. The story is everything that happened before it ever reached your pocket, and who decided it should exist at all. If this rearranged the way you think about money, you already know what to do next.